Nick, really good to see you. Today we are talking day trading, the risks and the rewards. Fueled by COVID lockdowns and the rise of commission-free brokerages like Robinhood, online trading or day trading has seen a huge rise in popularity in the last few years. Take a look at these new accounts created on E-Trade. Self-directed investing offers potential cost savings and learning opportunities. What are the other advantages?
Well, I mean, if you just look at that, it definitely tells us that we were bored during COVID.
I was bored.
Yes.
Yes.
Right. Yeah. I mean, it's almost like we had nothing to do. So what we're going to do is we're going to day trade because, I mean, it's exponential. If you actually look at that, it's crazy. And what happened with that is, granted, we had our phones and there was the ease of doing it. But then the problem also became a lot of inexperienced people got in the market. You know, as we know, there was that sell-off in March of 2020 where the market just, went down precipitously, and it was almost emotionally driven. And then the market bounces back and people are trading and it's like, oh, I'm making money. And then what happens is the market doesn't go up in a straight line. So eventually it starts going down, and then these inexperienced traders start getting hurt. So if we're looking at, what you were talking about, which is just saying, hey, what is the benefits or the advantages of that? I would say I have one guy, perfect example, is he spent $30,000 to learn how to trade. And then what happened is he went on to lose 30% twice, not just once, but twice.
Yikes.
After spending $30,000 to get trained. So one of the advantages is the cost savings. Yeah, but not really, because if you look, you can lose a lot more if you're inexperienced, and it costs a lot to get educated. So there's a cost for that too. And another advantage people will say, well, is, I get to do it myself. So there is that type of flexibility. I guess there's that type of, I get to do it myself kind of thing, which can be good. But then the other disadvantage to that is that you can make mistakes and just not know what to do. So when the market's up, it's great. But when the market goes down, maybe you get a little frozen and you just don't know what to do. And sometimes it's in those points in time where you can really get hurt because you're making emotional decisions that have maybe no experience to know, is this a right move or a wrong move, or who can I lean on to help me?
Right. And what you're hitting on right now is behavioral finance. We're going to get into that in 1 second. And I want to share this visual with you because I think this helps put the question in stark perspective. Studies found only 1% to 3% of day traders consistently earn above market returns. And you can tell from this visual, you might be more successful just going to the casino. What's going on? Why are we not successful as day traders?
Oh my gosh. I mean, can you imagine that? I mean, I'm looking at this right now, and I know you told me about this, and I thought, oh my heavens. I mean, and this isn't to say, folks, don't go out and say, oh man, casino gambling is going to be better than day trading, so I'm going to cash in and I'm going to go to the casino because I have a better chance of winning. The thing is this just tells me that how risky day trading can be when you compare it to casino gambling. And so a lot of times why we see this, why people, they're earning some money in the market and whatever, and they feel really good about it and they keep doing it, is in gambling, is we use our emotion over math. That's why it's a losing proposition. The casinos know this. The casinos know that if they get you hooked and they have all this stuff that if you win, you hear these sounds, you're going to feel this, just like on this chart, you feel this optimism, right? This excitement, this thrill that I'm making money, and this euphoria. And then as soon as the dealer starts winning, it's like denial. Like, oh, that was just rare. That was weird. Then we get anxious. Then we get fearful. And then we get depressed because we find half of our money's back on the table. And then we panic. And then we say, oh, you know what? Throw another $100 out there. Throw another $100 out there. And in reality, we take the same reactions into the stock market. A lot of people do. And that's the problem. Look at Bitcoin. Perfect example. I remember a couple years ago, it was the new rave. Everybody wanted to be in Bitcoin. Every kid was telling their parent and grandparent, put money in Bitcoin. This is the new thing. And then if we look at 2022, it was down 60%. And a lot of people now, they don't want to talk about it anymore. Bitcoin was the rave and the talk at the cocktail parties. Now, if you want to talk to somebody about Bitcoin, it's like, oh, what's Bitcoin? I don't want to talk about how much I lost. As a matter of fact, I have right here this thing called the Journal of Personal Finance. I mean, look at this, folks. This is a lot of stuff right here, right? A lot of information. And so in this Journal of Finance, there's a quote that's from the father of investing, Benjamin Graham. And the quote says, "The investor's chief problem and even his worst enemy is likely to be himself."
Yep.
And it goes on, this article goes on to say that investors who were actively managing things significantly underperformed the more passive investors. The reason is most average investors will tilt their common stock investments towards small cap stocks with high market risk, and they end up underperforming averages by 3.7% because they're in these higher risk things. And this paper goes on to say that the main point is simple: trading is hazardous to your wealth. And then it says, well, why then do investors trade so often? Because they believe that these high levels of trading can lead to overconfidence, and that overconfidence leads to over trading. I mean, it's right here. I'm not the mathematician or the genius that put this article together, but I mean, this is the reason why a lot of this happens and why the average investors don't make money, and why you're better off maybe going to the casino for some people.
We are humans. We are irrational.
We follow emotion.
Just ask my husband.
Not the math. Yes. Yes.
Okay, so let's say that somebody does want to open a trading account, maybe with guardrails. You say that they should have a few considerations first. And the first one you suggest, consider your approach and expectations. What does that mean? That
just means have an approach and have some expectations and make sure those expectations are legitimate, right? I mean, I've seen that people will come in and say, well, I want 35% returns with no risk. That's not a valid expectation, right? The market does not go up in a straight line. It goes up and down. So you got to first have an approach and have it definitive and have it dialed in. What am I going to do if this happens? What's my entry? What's my exit? And like I said, most traders, they don't have a system. They turn on CNBC. They hear somebody talk about something. They go on an online account and they purchase it. They don't know if they bought it at the right price. They don't know how they're going to get out of it. I mean, we see this at what we call, water cooler talk. When somebody will say, hey, I'm buying this. And then you go back around and then you go home and you buy it. And then like 5 months later, when you've lost a bunch of money, you go back and you see the same guy at the water cooler and you say, hey, I lost all that money on your deal that you told me to get into. And that guy says, oh, well, I was only in there for a couple of weeks. Well, you didn't tell me that. So that you got to find out what's the purpose of the money, because what ends up happening is when you try and day trade, you have to be right twice. You have to be right to get in and right to get out at 2 times. Mm-hmm. And so it's not as bad of a situation for people that are still working because they're dollar cost averaging. They're not spending their wealth. They're saving money. So if the market goes down, they're saving money in it. It makes it look like they're not losing as bad. But what happens when you retire is you're now using this money for income. So if the market goes down, it's even worse, because if the market goes down 30% and you're withdrawing 5% out of that to live, you now just went down 35%.
Right.
And now when the market comes back, there's not enough money in there to recoup what was lost plus what you took out. So that's why it's the slippery slope.
Yeah, compounding your losses.
Yes, absolutely.
The second consideration, your risk tolerance.
Yeah, so the what ends up happening is the ads that we see on TV are all about returns. Again, going back to Bitcoin, it was all about, look at all the returns that you get in Bitcoin. And then the disclaimer was very small down at the bottom. And if it was a TV, it was spoken very fast. Like, don't invest with money that you can't afford to lose. And it's sped up. So it sounds like a chipmunk is talking it through. But you have to be able to know not just the return potential, but what is the potential loss that I can have inside this investment? That's just as important, what we call your uncle point. No, can this go down 10%, 20%, 30%? Get it stress tested so you know how volatile are these investments that I have, because the market, again, does not go up in a straight line. So you're going to have these times where you've got to know, how big is this? I'll give you an example. We did a stress test for a person. Their average rate of return was 5.8%. But if the market goes down, they could lose 50% of their money. Now you tell me, is a 50% potential loss worth earning 5.8%? And to this guy, it wasn't. But yet a lot of people don't know that because they're only looking at the return potential, not the potential downside.
Right. And then last, of course, consider the risks. Two specifically. We touched on behavioral finance. Now I want to talk through tax implications, because a lot of these day traders aren't aware that they are creating taxable events when they move this money.
Well, and what ends up happening is they're usually taking money that's in a bank account, they're putting it in the stock market, and they buy something, they sell something, they're creating capital gains. And those capital gains is a detractor. Maybe it's not the best account is to use after-tax money for those types of trading. But the fact is, usually when people are looking at investing, is they're only looking at 20% of the picture. And what I mean by that is financial planning really has 5 parts. There is the investment side, but there's also the income side, there's the tax side, there's the healthcare side, and there's the estate side. You have to have a plan that looks at all 5 of those. That's what we call a 5-star retirement plan, is when you have a plan for all 5 of those. But when you're so focused on day trading and being a do-it-yourself person, what I find is almost overwhelmingly 90% of those people are so 100% laser focused on the returns of their investment that they're not even looking at the income side or the tax ramification or the healthcare side. They're missing all these other parts that also require a financial decision because they're all money-based.
Right.
And so you have to look at all 5 pieces of a total financial plan, what we call a holistic view, a 360-degree view, not just saying I'm only going to focus on the investments. Right. And that's all, because that must be everything because it's the dollar amount. Well, no, Social Security has stuff to do with that. And so is a bunch of other things.
Right. And having that plan is key because it prevents you from reacting emotionally like we are wont to do as humans.
Yeah, reactionary. I mean, I know we've talked about this before on other shows, is that do-it-yourself people tend to be very reactionary to what the market is doing, as opposed to creating an overall plan and having that plan run the show. And so, you don't get on an airplane, and a pilot doesn't get in an airplane without a flight plan. If you got on an airplane and you knew that this pilot has no flight plan, he's just going to emotionally fly this plane. He's not going to tell the tower anything. He's not going to tell his co-pilots or anybody anything. And he just took off. You'd probably say, I'm not getting on that plane. You would expect that pilot is going through his checklists and that he knows, like Sully when he landed in the Hudson, that if this happens, I'm going to be able to do that. And this is my protocol. You need to be that defined when it comes to your money, because you only get one shot to retire well.
Right. So Nick, if somebody wants to design that plan with you, what's the best way to reach you?
Best way is you can go to our website, Group10Financial.com. There's so much resources there, links to our YouTube channel, links to our Instagram page, links to our podcasts. And then also, the best thing sometimes is to be able to get a stress test done on your money to see where are you at? What's your baseline situation? Are you in a good place or a bad place? And that's something that we can do. And you can schedule a time, what we call a 15-minute retirement review. As you can set a time for that, where we can kind of see if there's any red flags that exist and if there's anything that can be done to help out.
All right. Nick, thanks so much for your time today.
Great being with you, Erin.